What are the drivers of IFRS adoption process and what are the benefits sought through them? Let us discuss that. IFRS adoption is primarily driven by the needs of large corporations, large financial intermediaries, and sometimes market providers. The objective has been the access to international public equity markets and seeking global investment opportunities. Highlighting the benefits expected of IFRS, European Union issued a statement in Brussels on 7 June 2002. It stated that it will help to eliminate barriers to cross-border trading in securities by ensuring that company accounts throughout the EU are more reliable, transparent, and easily comparable. This in turn will increase market efficiency and reduce the cost of raising capital for companies, ultimately improving competitiveness and helping boost growth. The statement made was not over-optimistic and has been established over time. IFRS has helped to eliminate barriers to cross-border investing. Easy comparison of financial statements between countries has affected international investors. International mutual funds have increased their stock ownership and has attributed it to reduced information processing cost and greater comparability of financial statements. US mutual funds, for example, have increased their holding in European companies that have adopted IFRS. IFRS are claimed to be high quality accounting standards. It produces more relevant and faithful information. The reason being reduction in the scope for managerial discretion through strong recognition rules, measurement, and disclosure requirements. Being principle-based accounting standards, their application has disallowed many allowable accounting alternatives. This has fostered accounting measurements that reflect realistically firm's economic position. For example, use of fair values for certain valuation purposes represent one such case. With reduction in discretions, their use is expected to restrict earning management behavior and promote high quality financial reporting. This has improved its usefulness for external as well as internal users. Analysts and investors are able to make advanced decisions through transparent and reliable financial statements. If we compare with previous domestic accounting standards, we realize that they have been designed to attend tax and government needs and were not adequately prepared to inform investors, analysts, and other market participants. IFRS are not only relevant to external parties but has facilitated management decision making as well. Although we have been emphasizing again and again on accounting quality, what do we mean by accounting qualities? Precisely, there is no universal definition of accounting qualities. But yes, they can be traced according to several attributes of good financial reporting. These may include accrual quality, timely loss recognition, earnings smoothing, earnings persistence, value relevance, reliability, and predictability. Accruals is one of the most important elements in the financial statements from the quality perspective. It reflects differences between reported earnings and cash flows arising out of difference in timing between payment receipts and supply of goods and services. These accruals can be income increasing as well as income decreasing. Whatever may be the case, higher the magnitude of absolute discretionary accruals, greater is the level of earnings discretion and thus lower the quality. Empirical evidences have proved that firms with better accruals are more likely to reduce the cost of capital and increase the relevance of earnings. Another common attribute of accounting quality is timely loss recognition. It prevents window dressing of financial statements and presents the true position. Accounting quality can also be looked through the volatility of accounting information. Investors react positively towards stable earnings. Interestingly, it has been found that investors lower this risk premium for non-volatile earning path, although highly volatile cash flows. However, there is a caution as well. Earnings smoothing may be used as part of managerial opportunistic behavior to meet budget targets, job security, or hiding firm real underlying performance. Thus, many times they are ill-advised and likely to be value destroying. Earning persistence has also become the focus of researchers and investors alike as an important quality parameter. It helps to measure future earning and thus firm's value and financial condition. Accounting convergence and higher quality information under IFRS has improved the comparability of accounting information. What do we mean when we talk of information comparability? Information comparability is the quality of information that enables users to identify similarities in and differences between two sets of economic phenomena. That is, there are two equally important facets of information comparability: the similarity facet and the difference facet. The similarity facet indicates whether firms engaged in similar economic activities report similar accounting amounts, and the difference facet indicates whether firms engaged in different economic activities report dissimilar accounting amounts. Because improvement in one facet does not automatically lead to improvement in the other, it has to be seen whether IFRS adoption improves both facets of comparability or at least improves one without impairing the other. Of course, intuitively, similarity facet is more appealing, and there has been empirical evidences supporting this. What is important to understand is that difference facet is equally important because an overemphasis on uniformity may reduce comparability by making unlike things look alike. For example, if IFRS allow fewer accounting choices than local accounting standards, then there are possibilities that their adoption could force firms to treat different economic transactions in a more similar way. However, to our disappointment, this is a less researched area and needs further attention. There are several potential benefits associated with enhanced information comparability. More comparable information enables smooth operation of global markets, facilitates international transactions, and minimizes exchange cost. Comparability is also positively associated with analyst forecast accuracy and negatively with forecast optimism dispersion. Considering the value relevance of information to investors, many studies have compared the domestic gap and IFRS through an Olson price regression model. This model helps to explain market value per share using earning per share and book value of equity per share. Studies have found that both earning per share and book value of equity per share significantly and positively explain market value per share during the periods followed by IFRS adoption. In earlier periods, book values failed to be the significant predictor of market values. This holds true even in countries with strong investor protection and enforcement regulations. However, evidence of enhanced value relevance of IFRS accounting information is country specific. While Australian evidence suggests that the combined relevance of book value of equity and earnings with IFRS adoption, evidence from the European Union is less consistent. Improvement in the quality of financial reports has also improved analyst information environment. It has helped in improving analyst forecast accuracy and number of analysts following firms. Simultaneously, it has helped to reduce dispersion of earnings forecast and target price forecast. Results are expected to be stronger in countries with a big gap between local standards and IFRS. IFRS based disclosures appear to have improved the efficiency of stock prices. Stocks market volatility are driven more by news about the firm itself rather than by news about other firms. You must have heard a famous saying in the market that liquidity begets liquidity. This is because more investors with money to invest and more companies seeking additional equity capital are drawn to more liquid markets. Market operators also like to run more liquid markets for fairly obvious reason of self-interest. It has been found that IFRS have a potentially beneficial role to play in fostering more liquid markets. Regarding cost of capital, research suggests that there is a negative association between IFRS adoption and cost of equity capital. This is because IFRS has assisted in the development of efficient equity market that has helped firms to tap cheap capital. Outside suppliers of capital provide funds at lower rate because higher trust in the organization as assured through their financial statements. Stakeholders foresee benefits because the firm's existing activities would become more valuable, future growth opportunities would become more worthwhile, and some otherwise marginal projects would become economically viable. Now, let's see the other side of the picture. The numerous benefits of IFRS that we have seen come with few disadvantages, and last decade saw sporadic efforts to identify IFRS transition and implementation challenges. These challenges relate to its complex nature, communication, translation, and its useful interpretation. It is equally important to understand the challenges faced by users and practitioners with respect to education, staffing, cost, training, and IT infrastructure. IFRS implementation is considered to be a costly procedure, particularly for small corporations. The widespread changes relating to deferred taxes, segment reporting, property, plant and equipment valuation, intangible assets amortization, and unquestionably the increased disclosure requirements are not easy for the majority of accountants to learn. Personal training has emerged as one of the major problems ahead. The task of implementing IFRS is further complicated as IFRS are still evolving and not yet being finalized in many jurisdictions. This challenge lessens the opportunity of a smooth transition to full compliance. It requires accountants to be constantly alert to the upcoming modifications. Hence, continuous training of accountants result into additional costs associated with IFRS. As many accountants are not IFRS competent, the transition is carried out by the external auditors in the majority of the companies. In such cases, there is large possibility that auditors might fail to play their proper gatekeeping role and to act as monitors of management's actions. IFRS implementation problems are aggravated by the fact that most firms have to prepare a different set of accounts for tax purposes. These accounts are prepared according to the provision of tax legislation. Thus, the companies bear costs relating to the application of two accounting systems. This has suggested the need for further attention from IASB and ICAI, particularly in an Indian context, to simplify the proposed convergence process. Special efforts are required from the accounting bodies throughout on training and awareness of the proposed changes among the present and the future workforce. A country's accounting policy making system comprises of the capital market structure, legal requirements, professional accounting standards, tax laws, and managerial philosophy. The existing institutional and legislative framework has not developed enough to allow an integrated application of IFRS. There are still many inconsistencies between Ind AS and the existing related laws like taxation, SEBI regulations, and banking regulations. The status of IFRS in relation to other laws is also not explicitly stated. It is a common complaint that the supervisory authorities do not provide adequate guidelines concerning the practical application of IFRS. Several variables like firm size, ownership diffusion, leverage, and type of auditor also influences compliance with IFRS. Corporate governance at country as well as at firms level also affect compliance with IFRS. Corporate governance influences firms' behavior in terms of its disclosure policy, transparency, financial policy, the quality of its accounting numbers, choice of auditor, and so forth. IFRS is more likely to be adopted in countries with strong corporate governance codes. This is because in such nations there is more voluntary disclosure of information and the loss of private benefits for company insiders is relatively small. The best accounting standards are only as good as the effectiveness of the regulatory process. Accounting standard setting is futile in the absence of enforcement. Without enforcement, the accounting rules will be only symbolic in nature. For being effective, they must be accompanied by sound program for monitoring compliance and imposing sanctions for non-compliance. Voluntary or laissez-faire approach might fail to yield the desired result. Evidence suggests that in many developing countries, professional self-regulation has failed. Therefore, it is in the public interest that the regulation of accounting should be done by an independent authoritative body. This raises an additional concern. With differences in the enforcement of accounting standards, there will be differences in financial reports and thus no reason to expect that financial reports will be comparable in different parts of the world. If the comparability of the information will be high only in countries where there is high enforcement, it is not defeating the very purpose of IFRS. Fair value as a measurement basis of assets and liabilities is a distinguished characteristic of IFRS. The IASB endorses the fair value approach in the context of relevance. However, the evidences of the 2008 financial crisis and other cases like Enron has casted doubt in its application. Use of fair value is expected to increase volatility in the reported values of assets and earnings. Additionally, IFRS may allow considerable discretion to both accountants and auditors to exercise their judgment and influence accounting numbers, hampering the financial reporting quality. Various variables of interest pertaining to IFRS are subjectively influenced. There remains a debate on what exactly constitutes accounting quality and how it should be measured. It cannot be directly observed and collected from commercial databases. Discretionary accrual models are also vague and limit their ability to monitor earnings. Another example is measurement of the cost of capital. Much can be done to refine these and other measures as a means of increasing the confidence in financial reports. Building in flexibility is a prerequisite in a world marked by constant change and innovation. The possible role of internal management system as an impediment in transition to IFRS has been aptly identified by world's premier business thinker C.K. Prahlad Krishnan. He observed that IFRS are likely to impact the organization's key processes of daily operations with customers and vendors and the way in which they communicate with investors. These modifications may further change employees' responsibilities. Many of the metrics used by investors and analysts to assess and compare companies are likely to change. As more companies consolidate their businesses under the new financial reporting requirements, they may need to renegotiate financing agreements, adjust debt covenants, and reconsider the implications for other long-term contracts. Control over processes and information may need to be revisited. New strategies may need to be devised, and information technology systems may need to be upgraded. Deep differences in socio-economic conditions, culture, and value system can cause substantial differences in accounting practices across countries. These differences cannot be removed overnight. Most market and political forces are local and will continue to be so in future. Consequently, the extent of convergence in actual financial reporting practice remain unclear. With differences in the degree of compliance, the potential benefits of a common set of accounting standards may never be realized in full. It is one thing to have uniform standards and another to have uniformity in practice. A link has also been drawn between the benefits of adoption and the strength of the firm's commitment to comply with the standards. More serious voluntary adopters have been found to benefit more from the larger increase in market liquidity and larger declines in the cost of capital. Voluntary adoption of IFRS has resulted in improved accounting quality rather than mandatory adoption. Now, summing up the discussion, numerous researchers have tried to investigate whether the transition from one's national GAAP to IFRS will bring improvements in the accounting quality. Nevertheless, researchers are not conclusive. Some studies have documented the increase in accounting quality. Many have produced mixed, ambiguous, or even negative findings. Country-specific factors and enterprise-specific factors have played their own role during the convergence process. The impact of IFRS is never guaranteed. It depends largely on the dynamics of the locality of the adoptee. When forced with complicated changes in the environment, people not fully adjust their behavior overnight. In the case of IFRS adoption, standard setters, preparers, regulators, auditors, analysts, and other users of financial statements can all take a significant amount of time to adapt. Moreover, IFRS are not static. New standards are being introduced and existing standards revised frequently. Further, the mandatory adoption of IFRS may not be solely sufficient to produce result in the absence of willing participation. With respect to education and training, there is a big role for university accounting firms, and professional bodies in equipping university graduates for a career in accounting, in developing well-trained teachers and researchers, and catering to the professional development need of practitioners. The professional debate about IFRS revolves primarily among high-skilled auditors, big multinational auditing firms, and representatives from industrial multinational firms. These groups have institutional and political vested interest in a common world standard and have always emphasized the superiority of the conceptual foundation of IFRS compared to the local standard. Accounting standards should have the force of law. Auditors' independence is also crucial in establishing the credibility and reliability of accounting reports. So, how do you foresee the future? Despite the one-time fixed cost to implement IFRS, accountants point out that the savings over time will dwarf away the initial outlay. It could even mean greater profits for firms. Investors will also have reasons to rejoice as the new standards make company financials easier to compare, enabling them to invest internationally with more knowledge and confidence. Like investors, auditors will appreciate the switch as it grants them greater room for judgment and interpretation. It may be a case that IASB will emerge as the leading standard setting body. In any event, there seems to be more IFRS adoption, although some countries will continue to allow local departures. MCA's roadmap for implementation of NTS has clearly conveyed the Indian government's commitment, but has also bring forth discussion on the implementation challenges for various stakeholders. Issues such as awareness, training, cost, interpretation, IT infrastructure, and staffing have been unanimously perceived as challenges for banking and other industries. Experiences of banking industry in the process of convergence would be interesting to investigate as it represents both the users and preparers' perspective. As a users, it deploys its funds from customers based on accounting reports developed from accounting standards. As a preparer, it accounts for transactions regarding non-performing loans, hedge accounting valuation, regulatory compliance and taxation. Further efforts from ICAI on training and awareness may be undertaken in the future. The ICAI has been found to be competent enough in the past and will prove to be so in the future as well. Thank you.